Today we're going to talk about structured notes. In particular, we're going to talk about three things. One, what exactly is a structured note? Two, we're going to look at real life examples of custom structured notes that have been built. And three, we are going to discuss, even if you like these terms for your portfolio, why they're probably not appropriate for you to implement. Okay, so let's get started. What exactly is a structured note? Well, a structured note, just look at the words. Note is another word for bond, a bond issued by a major bank. Structured just means we're able to control or influence the terms of the note and link it to a different asset. And so rather than a normal bond issued by a bank, they're going to give you 5% or whatever for a certain amount of years, and then you're going to get your money back at the end of that term. That's a bond that we're pretty familiar with. A structured note can be issued by the same bank, but the terms are different. And we're going to spend some time talking about those terms. Okay, so that's what a structured note is. What are the key components that you need to understand when it comes to structured notes? So the first, and I would say probably the most important, is what are the underlying assets? Or in other words, what is the structured note performance linked to? Now, you can call that your linked asset. You can call that your underlier. That's typically what it's referred to. But what drives the performance of this note? And next, it's the protection. What kind of protection are you getting in this note, if any? Next is your term. So how long is this note going to last? And then last is your payoff. In other words, how do I make money in this note? Is it income? Is it gains over the long haul? How does this note structured? So again, we have our underlier or our linked investments. We have our protection level, how long is it going to last, and then we have how are we getting paid. Those are all four key important factors, and as you'll see in the examples, as you change any of these factors, it's going to change the terms of the note, sometimes dramatically. So we know what a structured note is. We know four key important factors when building a note. I'd like to address a couple of questions that I get, which is, are structured notes risky or conservative? Well, they're whatever you build them to be. And so I've seen structured notes where they were built as FDIC insured, can't lose money, right? Sort of notes where, keep in mind, there's not much upside there. And I've seen notes that have been built to take more risk in the market with potentially more return. Okay, and so a structured note is structured however you want it to be structured. They can be incredibly conservative, they can be incredibly aggressive. So anyone that says structured notes are too conservative or they're too aggressive, that's not accurate. A structured note can be built in either direction. It's just important that you understand the risk and the return trade-offs. Okay, so let's dig in on a couple of specific examples of notes that were built. We're going to go through the four key important factors, and we're going to talk about what are the pros, what are the cons, what can go wrong, and you can see for yourself how this may or may not fit in a portfolio. Okay, so the first note that we're going to look at, this is what's referred to as a snowball note. Now, there are many different terms for these notes, but the snowball refers to, if you're thinking about, in the old cartoon days, you'd have a small snowball that started at the top of the hill, and as it went down the hill, it would accumulate snow and get larger. Okay, so this is a note where your premium payment or your payoff is going to accumulate as time goes on. And so let me walk you through what that looks like. So this was a note that was traded at the end of August of 2025. The linked investments, right, or the underlier, that's one of the key components, is IWN, EEM, and TPX. So what the heck is that? Those are three broad market indices. IWN is small cap value, EEM is emerging markets, and TPX is Japan. So the underlier is incredibly important because if the underlier does terrible, your note is probably not going to do well. And so why are these three the underliers in this note? Well, if you look at the expected rates of return moving forward, what history tells us is that you can buy broad asset classes or broad areas of the world that are not overpriced. You typically do pretty well as long as you give it enough time. And so you might be thinking, well, Kyle, where's S&P 500 or NASDAQ? Haven't those done really well lately? We should put those in our note, right? Well, here's the challenge is if you look at, and if you've watched any of my videos, what we've talked about is what history also tells us is that the more you pay for an asset, all else being equal, the more people are willing to pay a higher premium for a given set of earnings, right? And S&P 500 right now, and again, we're in the later stages of 2025, S&P 500 is about as expensive as it's ever been. Well, the more people are willing to pay for earnings, unfortunately, history tells us that means you have a lower expected rate of return. So if you have a historically expensive stock market, you could potentially have a historically low rate of return, and that would surprise no one. And so when we're building notes or any investment portfolio, you should be putting in assets that have a reasonable expected rate of return given the current price that you're paying. And when you look at small cap value, emerging markets, Japan, these are all moderately priced, broad indexes, broad baskets. So not just individual stocks. That's a whole nother video that we can talk about as far as doing stocks with these notes. It can be quite risky. Moving along, we're probably going to have some follow-up videos here based on questions that we're getting. Okay. So we have IWN, EM, and topics. So broad markets. Now let's go to the next line, which is how long is this going to last? This is a 5-year note. Now we'll talk about why these notes almost never actually last 5 years. They normally last 1 or 2 years, but we're going to come back to that. But that term is 5-year notes. And then what is the annual projected rate of return? Or in other words, what is the performance, right, that we discussed? In other words, how do I get paid? It's 20%, and that is if the markets are positive. Okay, so this specific note, and remember, all notes are different. This is just this specific note. If these 3 markets are positive on the anniversary date, in other words, on 8/30 of 2026, if these 3 markets are positive, you get paid 20%, long-term capital gains. You get bought out of the note. In other words, the bank says, here's your dollar, here's your 20 cents that you got in gains, and we're done. We're out of the note, okay? That's why these notes don't typically last 5 years, because the market doesn't usually take 5 years to be positive. Sometimes it takes 2. It could take longer, but just know that even though it's a 5-year note, many times they do not last that long. But again, the way the snowball works is if those markets, all 3 markets are positive in the first year, you get 20%, and then you're out of the note. And you better go just figure out what to do with your money. But what if the markets, one of these markets is not positive? It could very well happen, okay? Well, that 20% doesn't go away. Remember, this is a snowball. It's going to accumulate. And so you go to year 2. You look at August 30th, 2020 instead of 2026. You go to 2027. Are the markets positive now? Well, if they're positive in year 2, and it took 2 years for the markets to go positive, instead of 20%, you'd get 40%. You'd get 2 years worth of the premium payment. The same for year 3. What if it takes 3 years? It could take up to 5 years for the markets to be positive. And then once the markets go positive, if in the 5th year, you would get 5 payments of 20% and be called out of the note. And so when is this note useful? Well, if you don't think the markets are going to do much, if you think they're going to be flat for a while or just not return much, 20% rate of return is pretty darn good. Or if you think the markets might dip and come back. But the point here is this allows you to get a reasonable rate of return, and 20% is more than reasonable, obviously, without the markets needing to go up a lot. Because 20% is clearly a very high rate of return, but you don't need it to be up 20. It just needs these 3 markets to be positive at all. 0.01%. And so the snowball is a way to accumulate a high rate of return without needing a high rate of return from the markets. Okay, so we've talked about the time frame, this 5 years. 5 years is important because you could have a shorter term note. You could have an 18-month note, a 12-month note, but why might that not be great in this sort of a note? Because you need to give markets time to work. To use an extreme example, if we could buy a 30-year snowball note, eventually it's going to be positive because markets always end up positive just with earnings and growth and inflation. So we know it would be positive eventually. And so to use an extreme example, you could just use a really long term. Now the banks won't do a 30-year note. 5 years many times is the longest that you can go, which gives us the most time to let the markets work if it does take a while for the markets to be positive. So that's why we use longer term notes in this scenario. We talk about why we use these underliers or linked investments, because if you look at them, they're all reasonably priced assets. They're not overpriced like potentially the S&P or potentially the NASDAQ, which could take a dip and stay down for a while. If we look at the rate of return, that's our 20%. How do we get paid? In this case, the trigger is if these markets are positive. Okay, so if the markets are positive on the anniversary date, you get your 20% and you're out of the note. And then it looks every year after that if they're not positive, and it waits until it goes positive, and then you get paid that 20%. Now, I know we just went through a lot. This is something that you should be speaking with your advisor about specifically. We'll get to this later, but I didn't want to make this an incredibly long video. Okay, so let's go to the second note that we built, which is almost exactly the same linked investments, the same time, right? We built it on the same date. It's also 5 years. But if you look, the annual rate of return is only 14%. You think, well, Kyle, why would I want to get 14%, which is also very good, to be clear, if I could get 20? And the reason is in this note, right? So years 1 through 4, it's exactly the same, which if the markets are positive, you get your 20% rate of return. But in this note, the markets can be down up to 20% in the 5th year, and you get 5 years worth of your 14%. Okay, so in other words, the markets could be down 10% in year 5 in this note, and your 14% will have accumulated for 5 years, and you get a 70% rate of return in the 5th year. For your other note, you had 20% that was accumulating, but in that scenario, if the markets are down, you do not earn that 20%. You only earn it if markets go positive. Okay. Now, let me talk briefly about this. In that first note, your 20%, you have what's called a 20% soft protection or a barrier, which means you can be down up to 20%. The worst performing index can be down up to 20%, and you still get all your money back. But what happens if it's down more than 20%? If the worst index performer in this basket is down more than 20%, it's like you own the index. If it's down 30, you're down 30. If it's down 35, you're down 35. And so even though this is technically a bond with a bank, this is not a replacement for your bond exposure in your portfolio. We are using these as a way to diversify your equity positions, your stock positions. So keep that in mind. But we have 5 years, which when you give yourself plenty of time and you're buying broadly diversified assets at lower prices, you have pretty reasonable odds. Now, from a compliance standpoint, it's probably important that I talk about this just from a SEC regulator standpoint. This is not an offer that I am making. This is not a solicitation. You cannot buy these from anyone. This is not advice. Past performance is not indicative of future results. I kind of went through everything I could remember. I'm also going to put something up on the screen for you to read. But no matter where this is coming from and no matter how interested you are in these, this is something that you should not be trying to implement on your own because you can't directly go and negotiate with a bank. But also, this is something that you should be speaking with your advisor, make sure they know what they're talking about. We'll get back to that here in a minute. Okay, so looking at the two notes, these two notes were almost identical, except the difference was in the 5th year, you have that drop down where you can get positive rate of return even if the markets are down up to 20%. So in the 20% snowball note, that first one that we looked at where you can get 20% a year, the markets have to be positive on one anniversary date over the next 5 years, which realistically is a reasonable assumption. Okay. In the second note, this would be for a client that is more defensive. And they might say, well, yeah, that's still pretty good, but what I want a really high likelihood of, achieving this premium payment. And I really don't think it's going to be likely that the markets are going to be down more than 20% 5 years from now, in particular if we're buying asset classes that are not overly expensive. And they say, I'm willing to accept 14%. That's a very high rate of return. In particular, if I get that nice 5th year drop down, that gives me a lot of defense that I can play. And so the point here is we changed one lever, which is that 5th year drop down, and it changed your potential payment, your potential return from 20% a year to 14% a year. To be clear, both great returns. One is just more defensive than the other. And so that's how Snowball works. It's an accumulating rate of return based on a certain trigger and based on certain underliers. And you might be thinking, okay, well, that sounds really good. So when we're speaking about this with clients, most of the time the answer is, okay, that's ridiculously good. Why would the bank ever do that? The banks, they go and they have their own risk book. So they are taking whatever they want in terms of risk. Now, they're going to tell you they're buying a zero coupon bond, and then they're buying puts and calls to hedge it out. Some of that's true. The most important thing is we have a prospectus, and the bank has a legal obligation to pay us the terms of the note, no matter what they do with the money that we give them. And so if we're buying a regular 5% bond from a bank, or whether we're doing a structured note, the bank's on the hook either way. And so, yes, of course, we want these banks to be successful, but we don't necessarily care what they do with the money that we give them because they're contractually obligated to meet the terms of the note. Now, let me go to the banks really quick. It's important to remember that with these structured notes, you have bank risk. This is a bond issued by the bank. If the bank goes bankrupt, you own that bond just like a bondholder would, and that might not turn out great for you. So it's important that you're doing business with banks that are big, that are heavy depositor banks. Realistically, you probably only want to do banks with some of the biggest banks in the world and in the country because you know that, or you have a high likelihood that they will be just fine. And so that's important. You need to understand that the banks need to be in business in order to pay you, so only do business with reputable banks. And so, okay, We've talked about what a structured note is. We've talked about 4 important components. We've looked at real-world examples of custom notes that have been built and negotiated with the banks. And lastly, I said, you're going to probably look at those terms and say, those are pretty ridiculous terms. Why did you say they might not be right for me? Well, here's the thing about these notes. This is not like an ETF or a mutual fund or stock where you can take those returns that I just showed you and you can just go buy it in the open market, where you go on to Schwab or Fidelity or wherever, you type it in and you buy the note. This was a note that we had to custom negotiate with the bank, right? That's only distributed or only issued to our clients. And so that's going to be the same for any custom built note. And why am I saying that? Because it's not like you can just take this and bring it to your advisor and it can just be replicated. So bringing me to your advisor, I would say if you have not talked about notes in the past, it is likely that this is not something that your advisor does quite a bit of. And with structured notes, in particular custom built structured notes, which frankly are the kind that I would be recommending you, well, sorry, let me rephrase that. We don't make any recommendations, but keep in mind there are custom notes and then there are on the run notes, or in other words, the banks put out all kinds of notes that people can just buy into, and there's hundreds of them every month that you could go walk into your bank and buy into. Typically, the terms of these structured notes are not very good due to many things. We can probably create a whole nother video on this. It has a lot to do with hedging costs and fees and all kinds of things, but typically those terms are not good. It's in particular relative to a custom note that's going to be designed for a very specific outcome. Okay, going back to why this is realistically not feasible and not appropriate for most people's portfolio. Because with custom notes, these need to be negotiated a certain way, they need to be built a certain way, and this is not something that you do and tinker with. In other words, for your advisor, this should not be something that they kind of do on the side a little bit and see how things go, because they can go wrong if you don't know what you're doing. And many times, it's like a custom home build. Just because it's a custom house doesn't mean it's well built. Right? You can make all kinds of bad design decisions. Custom structured notes are exactly the same way. So are they good or are they bad? It depends on the note. And realistically, if you're working with your advisor, you like your advisor, your portfolio is on track, it's doing exactly what it needs to be doing, and you feel comfortable, I would probably not add this layer of complexity unless it's something that they do every day and fully understand, which is not that many advisors, candidly. Okay? And so here's why we're talking about this. It's because, one, I see all kinds of videos talking about they're good or they're bad, and there's a lot of misinformation out there, so I wanted to clear that up and use real notes, real terms. Okay, so you've seen what they do. Is that good or bad? Depends on what you're trying to accomplish. But most importantly, this is something that is really not something to dabble in. Okay, it's something to either find an expert in, that's great. If they are, work with them, see if you can get something that meets the outcomes that you're looking to meet. That's fantastic. More than anything, as I say in all my videos, you should know what you own and know why you own it. Hope you found this valuable. And as always, thanks for investing your time with the Personal CFO.